In all my years studying the markets, I've observed a truth that most traders ignore because it feels too simple. The market gives you signals long before it gives you profits. Yet still, 9 out of 10 traders miss the easy wins that lie right in front of them. Why? Because they refuse to see what is plainly written on the chart. Tell me, have you ever stared at a price level you knew mattered, only to second, guess yourself, and watch the market move without you? When I first learned the law of vibration in the markets, I began to notice that price swings were not random, and that the crowd always seemed to chase after motion instead of preparing before it. Most traders will wait until the move is obvious, and by then the opportunity has already passed. They let noise distract them from structure. They forget that the market is governed by natural order, and if you train your eye to read the chart the way a navigator reads the stars, the easy wins appear almost quietly. But how many traders give themselves the patience to see it? I've watched new students focus on the promise of quick profits, never realizing that fortune favors those who study the small details. A trend line drawn correctly can tell you more than a dozen opinions. A square of price and time will reveal the natural turning points. But people still ask, when will the big move come? When they should be asking, am I prepared for it when it does? Have you felt that pressure? The urge to jump in simply because the market is moving. You see, the reason most traders miss simple opportunities is because they want the thrill, not the discipline. They chase excitement instead of understanding. When the market is calm, they are bored. When the market is volatile, they are reckless. They ignore the fact that steady observation builds steady profits. In my own trading, I learned to treat every cycle, every retracement, as if it carried a message. And it always did. The market whispers long before it shouts. Are you someone who listens to the whisper, or only reacts to the noise? Over and over, I've seen traders fail because they do not trust their own analysis. They draw levels, then erase them when price tests those levels. They spot patterns, then doubt them because a candle flickers the other way. The market punishes hesitation just as surely as it punishes reckless action. But the saddest part is this: the easy wins. They miss were the ones their own eyes already noticed. Have you ever ignored a setup only to watch it unfold exactly as you suspected? There is a law that governs all speculation, and that law begins with self-control. A trader must master himself before he masters the chart. Many do the opposite. They want the chart to save them from their own emotions. They want certainty where the market offers only probability. They want wealth without building the habits that wealth requires. And so they miss the wins that come from calm, simple observation. Tell me, have you ever felt that pull toward impatience, urging you to act before the chart confirms your plan? I've always believed that the market rewards the trader who respects time. Time is the hidden key. Most traders look for price alone. Big numbers, big moves. Yet forget that price moves according to time. When you watch time cycles, half of your work is already done for you. But most traders don't study time because it feels slow. They want shortcuts. And in searching for shortcuts, they step over the very signals that could have brought them modest, consistent gains. Do you ever feel you rush past the basics because the market seems too slow for your expectations? Another reason so many traders lose sight of the easy wins is that they trade from hope instead of structure. Hope is a dangerous companion. Hope keeps you in losing trades longer than you planned. Hope tempts you to take trades your rules don't allow. Hope blinds you to the simple truth on the chart: higher highs, higher lows, momentum building in plain view. But the trader filled with hope sees only what he wants to see, never what the market is truly saying. Have you ever held onto a trade simply because you hoped it would turn in your favor? The mind of the trader must be aligned with natural law. That means accepting that markets move in cycles, advancing, pausing, retracing, and continuing. Easy wins come from understanding these cycles. A trader who knows the rhythm can enter quietly, ride the wave, and exit without fanfare. But the majority seek dramatic entries, explosive gains, and constant action. They want to feel the market, not study it. They want emotion, not insight. And the market, ever patient, waits for them to exhaust themselves. Do you find yourself craving action even when your plan tells you to wait? One of the most neglected principles among traders is the art of capital protection. Your capital is your business, your inventory. Guard it carefully, and it will serve you for years. Protect it poorly, and you won't survive long enough to see the wins that would have come naturally, the easy trades, the clean pullbacks, the clear breakouts, the measured reversals, show up often enough. But traders who are worn down by emotional losses no longer recognize them. Is your capital positioned to serve you, or are you spending your energy trying to recover from preventable mistakes? When I built my methods, I studied not only price and time, but the psychology of the crowd. The crowd always arrives late. They enter trades after the smart traders have already positioned themselves. And once the crowd piles in, the smart trader begins to exit. This rhythm never changes. So ask yourself, are you acting with the crowd or ahead of it? The easy wins appear before the crowd arrives. They are calm, orderly, and logical. But to see them, you must be willing to think differently than the majority. And still, most traders spend more time searching for complex systems than mastering the simple rules. They want indicators layered upon indicators, when the chart already offers everything they need. Simplicity is the true path to consistency. The market repeats itself. Human behavior repeats itself. Price patterns repeat themselves. Yet how many traders study these repetitions with seriousness? How many take the time to learn the natural harmonics that guide every trend? Are you studying the repetitions or chasing the exceptions? This is why 9 out of 10 traders miss the easy wins. It is not lack of intelligence. It is lack of patience, lack of structure, lack of respect for the chart. The market offers opportunity every day, but only those who learn to read it calmly, without fear or greed, will. Most traders overlook simple chart signals because they chase excitement instead of structure, and this is one of the great paradoxes of speculation. The market lays out its plans in clean, orderly movements, swing by swing, level by level, and yet the average trader stares right through these movements as if they were invisible. You might wonder why something so clear can be so difficult for most people to recognize. But if you look closely at your own trading experiences, have you ever found yourself ignoring a simple setup because it didn't feel exciting enough? In my time studying market geometry and natural law, I've learned that human nature is the root of this problem. People crave motion, drama, and the feeling of being in the middle of action. A quiet, textbook retracement seems dull. A steady trend feels too slow. Traders want the surge, the breakout candle, the rush of entering at the moment it feels alive. But the truth is that the market rewards patience, not adrenaline. And yet, how many traders fall into the trap of confusing excitement with opportunity? If you look at a chart with a trained eye, you'll see that the market often reveals its direction long before the big move begins. A higher low forms, a level is tested twice, volume shifts slightly, or price respects the same angle again and again. These are signals, simple ones, that tell you the underlying trend is preparing to continue. But traders overlook them because these moments don't produce the thrill they're secretly searching for. Have you ever caught yourself ignoring the calm part of the chart because it didn't look like anything was happening? The irony is that the easy wins hide in those quiet parts. When a trend respects its angles, when price vibrates around a level you've already mapped out, when time aligns with a natural cycle, the market is offering you a chance to enter with clarity. But a trader focused on excitement doesn't see clarity, he sees boredom. He wants the market to move now, immediately, dramatically. He wants fireworks instead of structure. And the market, indifferent to his wants, continues following its natural order. I've seen traders add indicators and overlays to their charts simply because the simplicity feels too uncomfortable. They want confirmation piled on top of confirmation because they don't trust the straightforward signals already present. They don't realize that every extra tool they attach to the chart becomes another distraction, pulling them away from the essentials. A clean chart rarely feels thrilling, but it is the clean chart that reveals the true geometry. Do you sometimes feel uneasy when the chart looks too simple, as if simplicity couldn't possibly be enough? Many traders also mistake volatility for opportunity. When price swings violently, the novice believes that action equals potential. But volatility without structure is just noise. It doesn't carry the same information that a calm, well-formed pattern does. A simple support level touched 3 times is a far better signal than a wild, unpredictable spike. Yet traders chase the spike because it moves fast, and they think fast movements will bring fast profits. The market teaches them otherwise, but only after they understand that excitement tends to cloud judgment. Another reason these simple signals go unnoticed is that traders often approach the chart emotionally instead of mathematically. They come to the market wanting a win, needing a win, or hoping for a reversal. Their emotions shape what they see. A clear uptrend becomes too high to buy. A clean pullback becomes not enough confirmation. A straightforward breakout becomes too obvious to be real. Emotion filters the chart until the trader no longer sees the basic structure. Have you ever found that your mood or expectations changed how you interpreted a chart, even when the signals were clearly present? There is also the problem of impatience. Easy signals require waiting. Waiting for the pattern to develop, waiting for price to reach your level, waiting for the candle to close. But patience is one of the rarest habits among traders. Most want to be in a trade, not waiting for one. They think that being active equals being productive. They fear missing out more than they fear making a poor decision. This impatience causes them to overlook the very signals that would have given them a steady, reasonable profit. How many times have you jumped into a trade simply because you didn't want to wait any longer? A trader who learns to respect structure instead of excitement begins to see the chart differently. He starts to recognize that the market's simplest behaviors, trend, support, resistance, time cycles, angles, carry the most reliable information. These elements repeat across all markets and all eras because they reflect human behavior and natural law. But understanding this requires a shift in perspective from wanting the market to entertain you to allowing the market to teach you. And that shift is harder for most people than they realize. Most traders also overlook simple signals because they believe trading should feel complicated. They think that success must come from mastering something advanced or hidden. This mindset leads them to ignore the obvious. They search for secret methods, complex strategies, or rare setups, all while missing the consistent patterns unfolding right in front of them. Complexity gives them the feeling of progress, even when it does nothing to improve their results. Have you ever noticed yourself doubting a simple setup because it didn't feel sophisticated enough? Understanding this keynote requires accepting a truth about the market and about yourself. Easy wins are rarely thrilling. They don't look dramatic. They don't feel urgent. They appear as modest, orderly movements that follow the rules of trend and time. But traders who chase excitement instead of structure will continue to overlook them. Easy wins are often missed due to impatience and acting before confirmation, and this single habit has cost traders more money than almost any technical mistake. When a trader becomes impatient, he stops seeing the market for what it is and starts seeing it for what he wants it to be. The chart may show a developing pattern, a forming angle, or a retracement that needs just a little more time, but impatience convinces him that waiting is somehow dangerous. Have you ever felt that urge to jump in early because you feared the move would leave without you? Impatience comes from a deep discomfort with stillness. Traders often believe that if they are not in a trade, they are not progressing. They confuse activity with productivity. They look at the screen, notice price hovering around a level, and feel compelled to do something. The truth, however, is that confirmation often appears only when the market is ready, not when the trader is ready. And yet, how many traders press the button simply because the silence feels unbearable? When the market is building a setup, it moves slowly and methodically. Price may inch toward a support zone. Test it, pause, and wait for volume to shift. These moments are where clarity forms, but an impatient trader interprets this quiet as a threat. He thinks, if I don't act now, I'll miss the move. That fear of missing out leads him to enter before the chart has confirmed direction and because the market had not finished its cycle. He ends up entering the noise instead of the signal. Have you ever entered a trade early only to realize the next candle did the exact opposite of what you expected? Acting without confirmation is essentially trading without evidence. A trader might see the beginning of what could become a trend, but without confirmation, it is still only a possibility. The market rewards probability, not possibility. Confirmation is what turns a guess into a calculated decision. Yet impatience makes a trader treat possibility as certainty, and that shift is where losses begin. The cost is not only financial, it also damages confidence. After a few early entries go wrong, the trader begins to doubt even the setups that are valid. Confirmation can take many forms: a break above a swing high, a candle close beyond a level, a retracement that aligns with time cycles, or a bounce that respects an angle. These small signals are signs that the market has chosen direction. They reduce unnecessary risk. Yet waiting for them requires discipline, something impatience erodes quickly. Notice how often a trader sees the beginning of a breakout, jumps in immediately, and then watches the price retrace back to the level it should have waited for. Have you had trades where simply waiting for the candle to close would have saved you? Another challenge is that many traders treat the market like a race. They believe the early bird catches the move, but in trading, the early bird often catches the trap. Markets are full of false breaks, misleading spikes, and manipulative wicks designed to shake out the impatient. Acting before confirmation is like stepping onto a bridge while it is still being built. You hope it will hold, but hope is unreliable in speculation. Confirmation is the test that ensures the structure can support your trade. Impatience also blinds traders to the importance of timing. Every market movement is influenced by cycles. Time cycles, vibration cycles, natural intervals where price is more likely to reverse or accelerate. When a trader acts early, before those cycles complete, he is entering during imbalance. Price may still be absorbing orders, completing its pattern, or aligning with its next rhythm. Entering too soon means stepping into incomplete structure. Have you ever entered early only to watch the perfect setup appear right after you were stopped out? The fear of missing out also contributes to premature decisions. Traders imagine the perfect move unfolding without them and feel anxiety at the thought of being on the sidelines. This emotional pressure pushes them to enter based on anticipation rather than confirmation. The irony is that waiting for confirmation usually allows a better entry, because confirmed setups often move more cleanly and with less noise. Impatience, on the other hand, leads to messy trades and emotional reactions that cloud judgment even further. Another reason impatience causes missed easy wins is that it disrupts the trader's ability to observe. A trader who is waiting calmly sees details: candle structure, price vibration, volume behavior, repeating angles. But a trader rushing to enter sees only what supports his desire to act. His vision narrows. He stops noticing the small signs that would have told him to wait. Confirmation is not just a technical concept. It is also psychological clarity. When you are patient, the chart becomes clearer. When you are impatient, the chart becomes a mirror for your emotions. Some traders convince themselves that confirmation will cost them profit. They believe waiting means entering too late. But confirmation does not steal opportunity, it filters out unnecessary risk. Many of the strongest moves continue far beyond the point of confirmation. The early portion of a move is often filled with indecision. Confirmation allows you to enter when the market is ready to follow through. And yet, impatience pushes traders to fight for the first few ticks instead of aiming for the more reliable portion of the trend. Impatience also hinders the development of skill. When a trader enters early, he interrupts his own learning process. He never gets to see how the full setup forms. He doesn't witness the natural signals that precede a true breakout or reversal. Over time, he becomes blind to the behavior that precedes strong moves, and this blindness ensures he misses the easy wins again and again. Have you ever realized that rushing into trades prevented you from understanding the very patterns that could have helped you? Ultimately, missing easy wins due to impatience is not about the market but about the trader's mindset. The market does not punish waiting, it punishes rushing. It does not reward those who act first. It rewards those who act correctly. It does not care how long you have been watching. It only responds when the pattern, the time, and the price align. Traders doubt their own analysis and erase good levels at the first sign of noise, and this habit quietly destroys more trades than any major market reversal ever could. The chart often gives clear instructions, but the trader's uncertainty interrupts the process. One moment he draws a clean support level, confident that it has meaning, and the next moment he deletes it because a single candle wick pushes slightly beyond it. He forgets that markets vibrate, that price rarely moves in straight lines, and that noise is not the same as invalidation. Have you ever marked a level, felt sure about it, and then removed it the moment the market breathed in the opposite direction? Every trader begins with good intentions. They perform their analysis with focus, map out zones, identify swing points, and observe the broader trend. But the moment they face the live chart, emotions enter. What they once trusted suddenly feels fragile. Noise shakes them. Small fluctuations appear threatening. A minor retracement looks like a reversal. The trader starts adjusting lines, redrawing zones, and convincing himself that the original idea must have been wrong. Do you recognize that moment when uncertainty starts rewriting your entire plan? This lack of trust in one's own analysis often comes from a misunderstanding of how the market truly moves. Charts are not perfect geometric drawings. They are living records of human behavior. Price overshoots, retests, fakes out, and vibrates around levels. This is normal. But traders expect precision to the exact tick, and when price behaves naturally, they interpret normal behavior as a sign that they misread the chart. The truth is that minor noise doesn't invalidate a level, it often strengthens it. A level that price tests repeatedly is a level the market respects. Yet how often do traders delete the very zones the market is trying to highlight? Another common issue is the fear of being wrong. Many traders carry the belief that a correct analysis must play out immediately and without contradiction. The moment the market moves slightly against their expectation, doubt floods in. They treat every small move as final judgment, forgetting that a healthy setup requires flexibility. The market rarely moves in a single direction without some pushback. A strong trend still retraces. A clean breakout can still retest. A supportive level can still dip before rising. But fear makes the trader interpret any deviation as a mistake. Have you ever given up on a level only to see the market respect it beautifully after you removed it? This doubt also comes from the pressure to be perfect. Traders sometimes believe that successful trading means predicting every move accurately. This creates an unrealistic standard. Analysis isn't about perfection. It's about probability. The trader's job is to identify areas where the market is likely to behave a certain way and then wait for confirmation. If the level is well chosen, the market will reveal its respect over time. But doubting that level prematurely prevents the trader from ever seeing the confirmation. The market was willing to cooperate. The trader simply didn't wait. Another problem is that traders are easily influenced by short-term price action. They zoom in too far, staring at tiny fluctuations that distort the bigger picture. A 1-minute candle spike feels catastrophic. A quick reversal feels like the entire market trend has changed. But when you zoom out, these movements barely register. They are simply noise. When a trader reacts to that noise by altering his analysis, he disconnects from the structure that matters. Have you ever noticed how different your levels look when you step back and review them calmly? This habit of redrawing levels also stems from a desire for constant certainty. Traders want their levels to look obvious and clean at all times, but the market does not provide that. A strong support may still see wicks pierce through before respecting the zone. A trend line may still see shadows dip below it. These imperfections actually validate the level because they show where liquidity lies and how price interacts with it. But the trader who expects perfection removes these levels before they have a chance to prove themselves. Another challenge is that many traders are overly focused on reacting rather than observing. Instead of trusting the work they have already done, they attempt to adjust their analysis in real time, almost as if they're trying to keep up with the market's every breath. But trading doesn't work that way. The market moves faster than any trader can think. That's why analysis must be done calmly, ahead of time. When you adjust levels reactively, you stop analyzing and start chasing. Have you ever felt like your chart becomes messier the more you try to fix it? Doubting your own analysis also creates a negative feedback loop. The more you second-guess your levels, the more your confidence erodes. Without confidence, even good setups feel unclear. You hesitate, you change your plan, and you miss trades that aligned perfectly with your original structure. This eroded confidence also leads to emotional trading. You may enter late, exit early, or hold on to losing trades simply because fear has replaced your logic. Over time, you stop developing your chart, reading skills because you never let your original analysis play out long enough to learn from it. Traders also forget that levels and zones are not predictions, they are areas of interest. They are places where the market may react, not guarantees of reaction. When a trader expects certainty and doesn't get it, he loses faith in the level. But markets don't work with guarantees. They work with probability, timing, structure, and human behavior. A level you draw is a hypothesis, not a promise. The more you treat it as a hypothesis, the more natural it becomes to wait, observe, and let the market reveal its intention. Have you ever felt more relaxed when you reminded yourself that your levels are guides, not commands? Ultimately, the trader who doubts his analysis is battling himself more than the market. The chart may be clear, the structure may be logical, and the level may be accurate. But if the trader cannot trust his own logical process, none of it matters. The noise becomes louder than the signal, and the trader becomes a participant in randomness instead of structure. The easy wins slip away not because the market hid them, but because the trader erased the very roadmap that would have led him to them. Hope-driven trading blinds people to clear price behavior, and this is one of the most subtle traps in the market because it feels harmless at first. A trader may tell himself he's being optimistic, patient, or flexible, but beneath that is something more dangerous, a refusal to see what the chart is actually showing. Hope is comforting, and structure is demanding. That contrast is why so many traders unknowingly choose hope over analysis. Think back to your own trades. Have you ever held onto a position, not because the chart supported it, but because you hoped it would turn? Hope has a way of distorting perception. A trader may see lower highs forming, momentum fading, and support weakening, yet he filters out those signs because he wants the trade to succeed. He stops reading the chart objectively and starts looking for anything, any tiny detail, that justifies staying in. A small bullish wick becomes a sign of reversal. A minor pullback becomes a potential bounce. A sideways drift becomes accumulation. In reality, the chart hasn't promised anything, but hope convinces the trader that the market owes him a favorable outcome. Have you ever caught yourself searching the chart for reasons to stay, instead of reading what price was actually doing? Another issue with hope-driven trading is that it delays action. A trader who hopes will hesitate to exit when the structure breaks down. Instead of cutting losses at logical levels, he waits. He tells himself the market might bounce. He imagines a future candle that will magically reverse the trend. This waiting can turn a small, manageable loss into a much larger one. And the longer he waits, the harder it becomes to admit the truth. Hope gives him emotional comfort in the moment, but costs him clarity, discipline, and capital. Have you noticed how much easier it is to hold a losing trade than to close it? Hope also overrides the trader's rules. A trader may have a perfectly sound plan, wait for confirmation, respect the stop, watch how price reacts at certain levels. But once he becomes emotionally attached to a trade, the plan dissolves. He widens stops, ignores signals, and abandons structure. The market becomes something he negotiates with instead of something he reads. This is why hope is so risky. It feels gentle, but it erodes structure quietly, one small compromise at a time. One of the most common forms of hope-driven trading is expecting reversals without evidence. Traders often fall in love with the idea of catching a turning point. They believe they can spot tops and bottoms simply because price has moved too far. But a market in motion tends to stay in motion until a genuine structural shift occurs. Without confirmation, stepping in front of a trend is nothing more than hope disguised as analysis. How many times have you tried to catch a reversal just because the trend felt overextended? Hope also fuels the belief that the market has memory of your entry. Traders wait for the price to come back to their break-even level as if the market cares. They mark the entry price on their chart and assume it is significant, but price structure is what matters, not personal reference points. The market will not turn simply because you want it to. It turns when supply, demand, and timing align. Yet hope makes traders treat their entry like a magnet, expecting price to return there out of fairness. Have you ever held a losing trade just to get out at break-even? Another danger of hope-driven trading is that it narrows a trader's attention. Instead of observing the full chart, the trend, the cycle, the volume, he focuses only on what supports his desire. He loses awareness of the broader context. He forgets to zoom out. He ignores the higher time frame structure. When the chart is read selectively, the trader becomes blind to major signals, trend breaks, retests, momentum shifts, and repeated failures at key levels.